Welcome to Corporate Finance. This is your online instructor, Diana Block, and I wanted to make a video to help out with the short application paper. I noticed that either your paper was not submitted or possibly incomplete or just contained some information that I think I would like for you to try to rework. So I don't want to, this is our first kind of large project, and I don't want to enter any low grades for that. So to avoid any type of low grades, what I'm going to do is go through a very, very similar problem as the short application paper problem. And that way you can use this as an example to follow completing the actual problem that's in Module 3, and you can resubmit the paper or submit it late, and that way you can still get just a little bit of late deduction and still get most of the points for the problem. So this video is to help you. For whatever reason, I've determined that I want to give you the opportunity to see a full example and then rework or submit the problem late. So let's take a look at the problem here. I've got some information here that is very similar to the information on the first part of the short application paper information. So the weights and amounts are different, but it's going to be the same process to work through the problem. So the first thing we need to do, the first calculation we need, is we need to find out what our cost of equity is. We need our cost of equity because we need to find out what is our weighted average cost of capital. And in order to calculate the weighted average cost of capital, we need to know the cost of each type of capital that we have in our capital structure. And it tells us here that we have, in this example, 40% debt and 60% equity. We're told here what the cost of debt is, so we need to find out what is the cost of equity so that we can see what our weighted average is for the both of them. So to find out our cost of equity, we have the formula here. This is the CAPM formula. I've added it up here. So this is out of our book and course materials. It's just the CAPM formula. And it says you take the risk-free rate plus the quantity of the beta times the market rate minus the risk-free rate. So the first thing you want to do is take the market rate and subtract the risk-free rate. So I'm going to add that information here. The market rate is 11%. The risk-free rate is 3%. So we're going to get the difference between these two items, and we're going to multiply that times the beta. Okay? So we're taking the market rate and subtracting the risk-free rate. Then we're going to multiply that times the beta. Then we're going to add the risk-free rate back on. So we want to do this in the order that I gave. So here I'm going to enter the formula and we can see what our result is. So we're going to take 3% plus our beta times market rate 11% minus risk-free rate 3%. Here's our formula. We're going to take the difference between the market rate and the risk-free rate, multiply it times the beta, and then add the risk-free rate back on. So that's going to tell us that the cost of equity, for this particular firm is 11.8%. So if I click in my cell here, you can see the formula that I entered. Okay, so here's how we arrive at the cost of equity for this firm. 11.8%. So now we can use this cost of equity to determine our weighted average cost of capital. So now we know that our equity is 11.8% as the cost of that. And the weight of our equity is 60%, as is given in the information on the left. And the cost of our debt. So we studied in our textbook, the debt has a tax benefit. So to get the cost of debt, we're going to take the given information, which is that the cost of debt is 11%, and we're going to multiply that times 1 minus our tax rate. Our tax rate is 40%. So that's what we're going to use for the cost of debt. 11% times 1 minus the tax rate. And then the weight of our debt is 40%. So we're going to take 11.8% times 60%, and then we're going to take 11% times 1 minus the tax rate times 40%. We're going to add these two results together. When we multiply these two times each other, and we're going to multiply these two times each other, and we're going to add the two products together. So let's see what we get when we do that. So we're going to say equals the cost of the equity times the weight of the equity plus the cost of the debt, which is 11% times 1 minus the tax rate, times 40%. Let's see if I got my formula right. Hold on. Yeah, just had to put the little asterisk or the multiplication symbol in there. So look at my formula here. I've got the cost of the equity times the weight of the equity plus the cost of the debt, 11% times 1 minus the tax rate, times the weight of the debt, 40%. So that formula gives me my weighted average cost of capital. So now we've got the weighted average cost of capital, we can look at the second half of the problem. Okay, so here we are. We're going to look at the second half of the problem, where we need to calculate the cash flows so that we can determine the NPV of this project and the internal rate of return on this project. So we're looking at this section of my spreadsheet where I've kind of got a format set up here so that we can track all of the cash flows for years 1 through 5, as well as the initial investments in year 0. So in year 0, that's now, the initial investment, what we're going to do is just add our cash flow, that we know our cash flow is 75 million. So we've already established that our initial cash flow is 75 million. This is what this project is going to cost us in year 0 to start it. So we've got that. Now we need to calculate what our cash flows are going to be for the remaining years. So we are told that revenue is expected to increase by 62 million annually. So we're going to start there with our revenue and try to determine what our cash flows are going to be for each of these years. So we've got our revenue listed here. Let me get a little more room on this spreadsheet. Oh, here we go. That's what I'm going to do. Okay. And so there's some information over here that says the gross margin is 65% of revenue. That 65% of revenue is the gross margin. Now, the reason that's important is that tells you how much is your cost of sales. If you'll remember from your previous finance or accounting courses, revenue minus the cost of sales gives you your gross margin. So if gross margin is 65% of sales, that means the cost of goods sold is 35% of sales. So we can determine what our cost of goods sold is for each year by taking our revenue and multiplying that times 0.35. And we want that to come out negative because we're going to subtract that. So this tells us how much our cost of sales are each year. And we're going to subtract this information, or subtract the cost of sales from our revenue, because we're working towards getting our cash flow. So now we need to determine our depreciation. So of the 75 million initial investment, only 60 million is machinery. So that's what we're going to depreciate, is only the machinery. We're not going to depreciate net working capital. And the depreciation is going to be straight line over the 5 years. Oh, the project life is 6 years. I'm sorry. It says 6 years on our example here. So that means $60 million worth of machinery. We're going to straight line depreciate it for 6 years. I had to add another year on here. Okay, so that means we're going to depreciate $10 million per year. And then now we need to determine what is our selling, general, and administrative expenses. It tells us that's 8% of sales. So we're going to calculate that by taking our sales times 8%. So now we've got our selling, general, and administrative expenses. Then we've got our, so if we take this information that we have so far and subtotal it, this is going to give us our operating income. So what I've done here is I've gotten our revenue minus our cost of sales, minus our depreciation, minus our selling, general, and administrative expenses to lead us to our operating income. This is the amount that's taxable. So we're going to take our tax rate, which on this part is 35%. There we go. And so we're going to take our tax rate times this operating income. Now we know how much our tax is. And we can subtract the tax amount from the operating income to get our net income. So here we are with our net income. And all we need to do now to get our cash flow, remember, we're not trying to find net income, we're trying to find a cash flow, which means we've got to add some things back on. We're going to add our depreciation back on because that's a non-cash expense. So we have to include it above in order to get our right taxable amount, but to get our cash flow, we need to add that back in. Also, we've got some recovered net working capital. That additional $15 million in net working capital, at the end of the project, we get that back. So we're going to add that back to our cash flow in year 6 only. So now we've got our total cash flow numbers. And so we're going to take our net income plus our depreciation, and when it applies, we're going to also add in our recovered net working capital. Okay, so now that we're here, look what we've got. We've got the cash flow for each year of the project. We've got the initial investment. We know the weighted average cost of capital because we calculated that before. So now all we have to do is get the NPV is get the present value of all of these cash flows and subtract the initial cash flow. And then what do we have to do to get the internal rate of return? All we have to do is use the IRR function on these cash flows. And then we will have our internal rate of return. And from there, you just compare the IRR and the NPV to the required returns as we talked about in class, and make your investment decision as to whether you want to accept or reject the decision. But this is how you get to all of the numbers that you're going to need so that you can calculate NPV and so that you can calculate internal rate of return. This is, if the numbers are different, but if you follow these exact steps using the problem information, that will get you to the right answers for the problem. If you have any additional questions before you submit it, make sure you give me a call and I'll be happy to help you. Good luck.